The global bond yields are crashing. The 10-year US Treasury bond has dropped from 4.68 to 4.42 in the last 27 days. The US 20-year has fallen from 5.21 to 4.92 in the same period. That's a pretty big move in the bond market. A lot of people don't really, I think we're numb to not seeing double digits, but I mean, when you're talking about a bond market, it's a very, very, very concentrated market. So to see something like that, billions and billions of dollars have to be moving in and out. Like that's what's crazy. And I don't think a lot of people really understand. But remember, the Fed is also now artificially buying those bonds. They are creating money and buying those bonds, and those bonds, which is called quantitative easing, but now no longer called quantitative easing because they changed the name to make it sound a little better. Kind of like when Biden was in office and they said that they changed the parameters of what inflation are like. They're going to do the same thing with Kevin Warsh. He speaks on Wednesday. That's going to be an interesting day because we're really going to see the mentality of what the next 4 years are going to look like in the Federal Reserve. But Japan is moving even harder. The Japanese 10-year yield is down 8.97% in 27 days, and the 20-year down 9.5%. That's the big moves that we're talking about today. When bond yields fall, it means bond prices are rising. Money is flowing into bonds across the U.S. and Japan at the same time. This is not a common market condition. Lower U.S. long end yields reduce borrowing costs for governments, corporations, and consumers without the Fed cutting a single rate. This is actually a very important discussion because what happens when companies, corporations, and countries can borrow money for little? When money is cheap, what happens? Growth happens.